Welcome to the Deep Dive. We're jumping straight in today, tackling a company that's, well, more than just a market player.
Definitely more.
We're talking about Nvidia. It's genuinely reshaping things, and we want to unpack the really big questions about where it goes next.
Absolutely. NVIDIA's impact, it stretches way beyond just its own stock price, It influences whole sectors. So this deep dive, it's about getting under the hood, understanding the forces shaping where it is now, and crucially, what that might mean for its future and for how you see the market.
And what a presence it has right now. We're looking at a market cap of, what, $4.3 trillion?
Astounding number.
To give you some perspective, that's nearly 8% of the S&P 500, over 9% of the NASDAQ 100. That's more clout than any single stock has had in decades.
Unprecedented, really.
The price is around $177, $178. But the PE ratio, 50.61.
That's not expensive, yeah.
So the burning question, I think, for everyone listening is just, can it keep this up, this incredible growth? Or are we maybe seeing the magic start to wear off a bit?
That really is the multi-trillion-dollar question, isn't it? And
yeah.
Yes, its sheer size means its ups and downs can pull the whole market along.
Right.
But then you have the law of large numbers. It just gets incredibly hard to keep growing at that kind of exponential rate when you're already this massive.
Yeah, that makes sense.
And we are seeing maybe some early signs of that moderation in the latest figures.
You're right. The numbers. They tell a really interesting story. If you think back, especially during that AI boom, that wow factor, May 2023 really jumps out.
Oh, yeah. That forecast.
Exactly. Nvidia stunned Wall Street. Forecasted $11 billion revenue. That was, what, 53% higher than analysts expected. Just huge.
Totally blew expectations away. And that really kicked off this unbelievable run of growth, sent the market cap soaring into the trillions.
That moment, May 23, it felt like a real turning point, didn't it? Like signaling just how big this AI wave could be.
It did. And it set this incredibly high bar for what investors started expecting from NVIDIA quarter after quarter.
Okay, so if May 23 was maybe peak, wow, what's the story been more recently? Things have shifted a little.
Uh-huh.
The latest quarter, for instance.
Yeah.
They still beat expectations, which, is good on its face.
Still a beat, yes. Important to note.
No, it was actually the narrowest beat they've had in 9 quarters.
That's the key point, the margin of the beat.
And the shares reacted, right? Dropped about 6% after the result.
They did. Showed some investor hesitation there.
And even though revenue growth was still, objectively strong, 56% year over year, that was actually the slowest pace they've shown in over 2 years.
Exactly. And if you track that specific metric, the analyst beat delta, that's just the percentage they come in above the consensus estimate.
Right.
It really maps out this trend of, let's say, normalizing expectations. Back in Q2 2024, they beat by over 20%. Massive.
Wow.
Then it dropped. Q3 24, around 13%. Q4, maybe 8%. Q1 of 25, roughly 5%. Then Q2, just 4%.
So steadily shrinking.
And the projections looking forward, they suggest maybe 5% again for Q3 25, but then down to 3% in Q4 25, and hovering around just 1.5% for the first half of 2026. So what that really tells you is, well, the era of those absolutely explosive, jaw-dropping surprise beats, it seems to be fading. Growth is still happening, let's be clear.
Right, growth is still there.
But expectations are much more aligned now. There's just less room for NVIDIA to really blow the doors off and impress the market in the same way.
So if those massive beats are harder to come by, let's talk about why growth might be moderating. What are the key factors?
Right.
First, you mentioned the scale effect, just the law of large numbers, basically.
Exactly. It's fundamental. When you're already enormous, putting up the same percentage growth gets exponentially harder. Think about, Apple or Microsoft in their mature phases.
The comparison.
They hit a point where 50% growth just isn't feasible anymore when your revenue is already hundreds of billions. NVIDIA is now bumping up against that same kind of ceiling. Every extra billion is harder fought.
Makes sense. Okay, second point, supply chain constraints. This seems persistent. They rely so heavily on TSMC for making the chips.
Very heavily. And these AI systems are incredibly complex. We're talking maybe 600,000 parts now, potentially jumping to 2.5 million parts in future systems.
Wow.
And it takes time. About a year from starting chip production to actually delivering a finished supercomputer.
And the data we have, looking at their supply metric inventory plus commitments, it shows steady growth, right? $41 billion to $45 billion quarter to quarter.
It does. Steady, but not explosive.
Which sounds good, but what does it really signal?
Well, it suggests they aren't, stockpiling a massive amount of chips in anticipation of another huge surge,
Yeah.
nor are their customers making huge advanced commitments way out into the future that would signal another wave of hypergrowth or the ability to deliver a big upside surprise on supply. It suggests things are more measured.
Got it. Not just some chips, but enough of the most advanced ones.
Exactly. And the whole chain, design, fabrication, that complex advanced packaging, it all needs to scale up together. It's a bottleneck.
And then there's a third major constraint emerging: energy.
Oh, this is a big one.
AI compute is just incredibly power hungry.
Immensely so.
And the problem is our power grids. They just aren't expanding fast enough. Utilities seem hesitant, maybe understandably, to pour billions into new capacity without knowing for sure how long this AI demand spike will last.
It's a massive challenge for them. They plan infrastructure decades ahead, usually. AI demand is moving at internet speed.
There's this analogy like widening a road.
Mm-hmm.
Making chips more efficient doesn't necessarily cut power use overall.
Right. It often just encourages more use, more AI models, bigger models.
So yeah, if you're running a utility,
Yeah.
how do you even plan for that kind of potentially exponential but maybe uncertain demand?
It's a real headache. Multi-billion-dollar bets with uncertain timelines. And this brings us to a really critical takeaway. The bottlenecks aren't just about silicon anymore. Power and the broader infrastructure needed to deliver it could seriously define Nvidia's growth limits going forward. It's a bigger, more systemic challenge now.
Okay, shifting gears a bit. Beyond the numbers and the physical constraints, there's this whole other layer, geopolitics. Specifically, China. What's the latest there?
Yeah, this adds a whole lot of volatility into the mix. So back in April, the U.S. government blocked sales of Nvidia's H20 chip into China. That was a direct hit.
Okay.
Then more recently, in August, there were reports CEO Jensen Huang was talking to the Trump administration, trying to find a way to resume sales.
I heard about that. Some kind of proposal involving giving a cutback to the government.
Reportedly, yeah, something like giving 15% of the China sales revenue back. But key point, that deal isn't done. It's still up in the air.
So why does China matter so much for Nvidia? What's at stake?
It's huge. We're talking an estimated $50 billion opportunity, and it's growing fast, maybe 50% a year.
Wow. Okay.
And Nvidia definitely wants to sell its next-gen stuff, like the Blackwell processors, there eventually.
So what's the near-term impact of this uncertainty?
Well, Nvidia themselves said they could ship maybe $2 to $5 billion worth of those H20 chips in Q3 if they get the green light.
That's a big swing factor.
A huge swing factor. But, and this is important, their current official guidance for Q3 revenue, that $54 billion plus or minus 2%, it excludes any potential China shipments.
Ah, okay. So that'd be pure upside if it happens.
Exactly. It highlights the dilemma. China's this massive growth engine, potentially, but it's also a major geopolitical football, creating significant risk and uncertainty. The outcome there could literally shift quarterly results by billions. Definitely something to watch closely.
Okay, let's circle back to the hard numbers from the last quarter again. Data center revenue, $41.1 billion. Strong year over year, 56%.
Oh, very strong, yes.
But the quarter over quarter growth, only 5%. That's definitely slower than the 10% pace we saw before.
A noticeable deceleration in the sequential growth, yeah.
And the guidance for next quarter, that $54 billion plus or minus 2%, it's basically just a little bit above what analysts were already expecting. Not a big beat there either.
Right. Met expectations, maybe slightly exceeded, but didn't blow them away.
And we mentioned the investor reaction stock down 6% after earnings.
Yeah.
And over the last month, roughly, the NASDAQ index was up maybe 1%, while Nvidia was down about 9%.
And that reaction matters a lot because with Nvidia's, frankly, stretched valuation and its huge weight in the indexes.
Yeah, the PE of 50.
Exactly. Even small signs of a slowdown or beats that are just narrower than expected can trigger a pretty sharp pullback in the stock. It's super sensitive to any perceived change in that growth story. It's not just about growing anymore. It's about growing faster than already very high expectations.
So let's look longer term. Jensen Huang, the CEO, he paints a huge picture, right? Talking about AI infrastructure spending hitting maybe $3 to $4 trillion by 2030.
A massive number, a truly transformative vision.
And he's talking about the next generation Rubin chips coming early next year, timed with what he hopes is a more mature supply chain.
Right. The long-term vision is definitely still ambitious and compelling.
But what are the analysts saying? Are they all buying into that smooth path to trillions?
It's a bit mixed. You've got firms like UBS suggesting, yes, supply will be okay for steady growth, but maybe not for another round of, explosive acceleration.
Okay, so more moderate.
But then you have others like Benchmark and JP Morgan who seem more bullish. They note the recent results are pretty much in line with what Nvidia aimed for, and they still think Nvidia will capture the lion's share of new AI spending.
Interesting contrast.
Yeah, it really highlights this tension. The long-term story, the secular trend for AI, that seems intact. Nvidia is clearly dominant there.
Right.
But the near-term growth path looks, well, flatter than it was. It's that big picture vision versus the quarter-by-quarter reality that investors are grappling with right now.
Okay, so for you listening, trying to make sense of all this, what are the key risks you really need to keep an eye on?
Good question.
First, seems like supply chain fragility is still there. That reliance on TSMC, the complex logistics.
Definitely. Any hiccup there is significant.
Second, power grid limitations. We talked about this data centers needing way more electricity than grids can easily supply right now.
A potential hard ceiling on growth, yeah.
Third, geopolitical exposure. That China situation remains a big unknown. Approvals, restrictions, it's unpredictable.
Absolutely. High risk, high reward potential there.
And finally, just valuation risk.
Yeah.
That PE around 50 is, well, it's expensive. It prices in a lot of future growth. Any stumble, any earnings miss, or even just a slightly weaker beat could hit the stock hard. There's very little margin for error.
Precisely. And beyond those risks, what should you actually be watching over, say, the next 6 to 12 months to get a clearer signal?
Yeah, what are the indicators?
Well, obviously the launch and crucially the adoption rate of those new Rubin chips. How fast do customers buy them? Keep an eye on TSMC's capacity for advanced packaging. That's a key bottleneck. Watch NVIDIA's own supply metric, that inventory plus commitments number.
Right, the $45 billion figure.
Exactly. See how that trends. And critically, watch the data center revenue quarter-over-quarter growth. Is it reaccelerating, staying flat, slowing further?
Makes sense.
Also, obviously, any policy decisions coming out of Washington or Beijing regarding those China chip sales, huge impact potential. Watch the big cloud players, Amazon, Microsoft, Google. Watch their capital expenditure announcements. Are they still spending big on AI infrastructure?
Good point. Their spending drives NVIDIA's sales.
And lastly, look for news about energy and grid capacity expansions, especially in those major AI development hubs. Are they actually building the power infrastructure needed?
Okay, that's a great checklist. So ultimately, what does this all boil down to for someone trying to figure out NVIDIA?
Well, look, Nvidia is still an incredible company, a money-making machine, totally dominant in AI hardware. That's not really in dispute. But as we've laid out, the growth is moderating. Scale, supply chain issues, energy limits, these are real constraints now.
And the China situation adds volatility.
Yep. And the valuation is very high, leaving, as you said, little room for error.
So it really presents this clear investor dilemma, doesn't it?
It does. Nvidia will keep growing. The question is, will that growth be strong enough, fast enough to justify today's stock price?
Right.
With those earnings beats getting smaller and these constraints becoming more apparent, you have to decide. Do you take some profits now, acknowledging the near-term headwinds, or do you hold on tight for that huge long-term $3 to $4 trillion AI vision?
Yeah, tough call.
It is. And honestly, the next few quarters are going to be absolutely crucial. They'll give us the clearest signals yet about which path the stock is really on.
A lot to think about there. The future of a company this influential, it really touches so many parts of our tech world, doesn't it?
It really does. This deep dive, I think, shows the incredible mix of forces at play, technology, yes, but also infrastructure, global politics, basic economics. It definitely leaves us with a lot to mull over.
Absolutely. Okay, just a reminder for everyone listening, we are not certified financial advisors, and this content is only for educational purposes. If you are considering making any investment decisions, please make sure you consult with a certified financial advisor.